Welcome to this short how to tackle video. In this session, we're looking at a calculation that sometimes catches people out, which is traded interest rate options. We'll use an example to talk you through the steps to success for this sort of calculation. The information from the scenario is included in the video description, so you're welcome to have that to hand and work along, or just watch me take you through the stages. Either way, hopefully you'll see that these are very doable calculations if you stick to the steps. Okay, I'll shrink down a bit so you can see the screen more clearly. Let's have a read through the scenario. This is the sort of information you'd get on the day of an exam or you'd have to gather in the real world. So, today is the 30th of September. Our company needs to borrow £2 million for 3 months, starting on the 31st of December, so in 3 months' time. We're keen to ensure that our interest rates on this loan do not exceed 4% per annum. Sterling options on 3-month futures contracts have a contract size of £500,000 and premiums in annual terms are, and we have this little table here. Now this is a premium table. It lays out all the different options that we have available to us that we could take. Different strike prices, so 95 or 96, different types of options, so put and call, and different dates, so September, December and March. Essentially, this is going to let us work out how much we have to pay the bank for the privilege of taking out an option. We'll look at how to interpret that later, but just be aware that it's there. On the 31st of December, the interest rate is 4.25% and the futures price is 95.75. So there's quite a lot of information with different dates and interest rates here, which I know can look a little bit daunting. Before we tackle the answer, there are a couple of things that you might notice from the scenario. First up, just make sure you're happy with the dates that things are happening. The loan is coming up in 3 months' time at the end of December, but the futures hedge will start at today's date, which is the 30th of September. So spotting that can just help you understand kind of what rates and figures to use as we progress through the stages. In this scenario, we're looking at traded options. The easiest way to think of them is that they're really just like traded futures, but we have the option as to whether we close the future out and complete the hedge or whether we just walk away from it. So they're very, very flexible. But that means we're still looking at information about futures here, even though it's an options question. We're really just giving ourselves an option on what we do with the futures. And that will hopefully make a bit more sense as we go through the calculation together. Finally, remember that unless you're told otherwise, all the interest rates in this sort of scenario will normally be quoted as annual percentages. So bearing all that in mind, let's jump into the calculation. First things first, before we try and tackle the main calculation, we need to set the hedge up. There are 5 things that you need to be able to identify from the scenario before you get into the main calculation. First up, we need to decide whether we're buying or selling futures on the 30th of September to start off our hedge. The rule is, if we are borrowing money, so if we're trying to control the interest on a loan like we are in this scenario, we sell interest rate futures today to start the hedge off. If we were depositing money and we're trying to fix the interest rate we earn using futures, then we would buy futures today. So, because we are hedging a loan, we sell futures today. Now, when we're looking at options, we need to decide what type of option this relates to. And there's just a bit of extra terminology to remember for that. An option to sell futures is what we call a put option. If we wanted the option to buy futures today, it will be a call option. So in this case, because we're borrowing on the 30th of September, we need to sell futures today to get it started, which gives us the option to sell futures, which is a put option. Next up, what date futures do we need? Futures are for standardized amounts and standardized dates, so you may be given several possible dated futures to pick from. The rule is that it's always the futures that are the closest after the date of the transaction that we're trying to hedge. In this case, our loan that we're trying to hedge is going to be taken out in December. So we need December interest rate futures. You'll see in the premium table that we could choose September, December or March ones. They're both available. So we just ignore the March and September ones and go for December instead. So that's our first two things that we need to figure out. Thirdly, what value of option do we want to enter? Put another way, what strike price do we need? Now have a look at the premium table and you'll see there are two possible futures values we can choose between called strike prices, either 95 or 96. What do these mean? Well, remember that futures are valued at 100 minus R. So 100 minus the interest rate. So, if we had an interest rate of 3% per annum, the futures relating to that would be priced at 97. So a strike price of 95 or 96 would suggest that we're trying to cap our interest rates on our loan at either a maximum of 5% if we choose the 95 strike price, or a cap of 4% if we choose the 96 strike price. Now in the scenario, it tells us we don't want to exceed 4% payments, so we need to enter 96. Our next bit of setup is calculate how many futures contracts we need to cover our transaction. Now, as well as being for set dates, futures are also for set amounts of money. In this case, each future, we're told, covers £500,000 worth of our loan. That's their standard contract size. Remember, while it's not mentioned in the scenario though, futures also only cover a 3-month period. So each option or each future covers £500,000 of loan for 3 months. So to find the total number of contracts we need, we take the loan that we're trying to hedge of £2 million and we divide it by the size of each futures contract of 500,000. So that gives us, 4 contracts. Now remember, our loan will only run in this scenario. We're only going to take the loan out for 3 months. So those 4 contracts will cover the whole value of the £2 million loan, and it will last for the full 3 months of the loan's term. If the loan had been for, say, 6 months, we'd have needed twice as many contracts. If it had been 9 months long, we'd have needed 3 times as many contracts. But in this case, it's only a 3-month loan, so essentially those 4 contracts will see us right for the whole duration. Now, it might seem a bit pointless to add multiply by 3 months over 3 months into the calculations here, but I always show it just to make sure that we never forget to multiply by the contract length of the loan divided by 3. Now, as it turns out, this comes out, in this case, at exactly 4 contracts. Remember, contracts aren't divisible. So if we hadn't got an exact number of contracts, we would have had to have rounded that number to the nearest whole number. Often we round up to the next whole number to make sure we're fully hedged. There's one last thing we need to do, which is to identify the premium that we're going to have to pay on the option, which is what that premium table was there for, if you remember. Now, regardless of whether we exercise the futures or not, if we enter an option, we have to make a payment to buy it. And that's what the premium table helps us work out. Now, if you have a look at the table, based on the information we have, we can identify the premium that we need. We want a strike price of 96 for a put option in December. That gives us a premium of 0.6. Now, what does that premium mean? Well, it's a premium of 0.6% per annum of the total amount that we've hedged using futures. So what is that in total? Well, we take the 0.6%, watch your decimal places, and we multiply that by the contract size of 500,000 and by the number of contracts, which is 4. That will give us the annual cost of the premium, but remember, futures only run for 3 months, so we have to multiply that by 3/12 to get the amount we actually pay as a premium. So in this case, that comes to £3,000. So that's the premium that we're going to pay in order to essentially have the right to buy this option. And that's the setup. It might seem like a lot of work, but those 5 questions are each pretty straightforward when you get used to them. Once you've gathered the information, then you can go on to finish your calculation. So let's look at the steps to, in this case, do the hedge. Now, I've got rid of the premium table from this slide because we've got what we need from it and we needed a bit more room. Now, the main calculation is happening on the 31st of December when we take out our loan. The first step is, well, we take out the loan and we take it out at whatever the prevailing rate of interest is on the 31st of December. So our £2 million loan will pay an annual interest rate of 4.25% for 3 months. So that's 3/12 of the annual charge. So that gives us an interest payment in total for this loan of £21,250. Now, you might be thinking, but didn't we hedge using options on futures? The answer is yes, we did, but the hedge is a separate transaction. So we just take out the loan as if nothing had happened. So basically, the first stage, we just pretend we haven't hedged at all. Next up, we tackle the option itself. Now, I think it's easiest to do this by looking at one futures contract at a time to start with. Now, think back to our setup on the last slide. We said that to start the hedge off, we had the option to sell futures on the 30th of September because we were borrowing, and that the strike price we'd chosen was 96 to try and cap our interest payment of 4%. So that gives you our first line. We have the option to sell each futures contract at 96. On the date of the transaction, so on the date, the 31st of December, the date we take our loan out, we have to consider if we want to close the future out by doing the exact opposite of whatever we started with. So as we sold futures on the 30th of September, we have to decide if we want to buy them back on the 31st of December to complete the hedge. And to do this, we'd have to pay whatever they're currently trading at. In this case, according to the question, if you look at the last paragraph, on the 31st of December, the interest rate's 4.25% and the futures price is 95.75. So there's our next line. We want to see if we've got the option to buy each of these futures back at 95.75 on the 31st of December. Now, in a dazzling bit of mental arithmetic here, if we sold for 96 and we bought back at the lower price of 95.75, this means you'd make a gain on each contract of 0.25. Now, we like gains. Gains are good. So we exercise the option and we do just that. We sell and buy the futures back and make a gain of 0.25% per annum per pound hedged. Now, if the trade here had come out as a loss on the futures, that's where the option shines. If a loss occurs, we'd literally just walk away from the hedging transaction, which we'd call letting it lapse, meaning we'd end up with a loss of 0. We just don't bother with the transaction. No further calculations at all. Whack a 0 in as your total loss on the option, and that's it. However, in this case, it's a gain. So we exercise the option and use that to make a bit of money. Well, how much money do we make from the futures then if we're going to make this gain? Well, we have to figure out the total gain we get from this across all the interest rate futures that we traded. So what we do is we take that 0.25%, watch your decimal places if you're doing this on a calculator, and then we multiply it by the number of contracts, which is 4, and the contract size, which is £500,000. That will give you the annual gain we made in total. However, remember, futures only run for 3 months each. So annoyingly, we have to always multiply that total figure by 3/12, because it's annual at the moment, to get the actual total gain that we've made. We don't want the annual cost, we want the actual figure. So multiply by 3/12. Remember, this 3 months has got nothing to do with the length of the loan in the scenario. Even if the loan we were hedging here ran for 120 months, we'd still multiply here by 3/12, because that's how long the futures themselves run for. So the value of our gain is £1,250. We then set this off against the interest that we've paid on the loan at open market rate. Now, if we subtotal this here, so we take our £21,250 payment, net off the £1,250 gain, we get £20,000 of net interest payments. Now, let's sense check this. Remember, we used options with a strike price of 96, And we said this was us trying to cap the interest on our loan at a maximum of 4%, so 100 minus R. Now, we paid a net amount of £20,000 on our 3-month £2 million loan. If you divide the interest by the loan amount, we get 1% as an interest rate. But remember, the loan only ran for 3 months, so it's 1% interest per quarter. So to get the annual interest, you'd need to multiply that 1% by 12 over 3. Essentially, the annual interest would be 4 times that figure. So £20,000 of interest over 2 million, grossed up by multiplying it by 12 over 3, gives you 4%, which is what we were trying to cap our payments at. So it looks like the option has actually worked pretty much perfectly. So the prevailing interest rate when we took out our loan on the 31st of December was 4.25%. Thanks to our option, we've managed to essentially cap it at the lower figure of 4%. However, we won't quite achieve 4%. This is because we have to consider one extra line for an option, which is the premium. Now, this is always payable on an option. Whether we exercise the option to get a gain or whether we let the option lapse because there's a loss we don't want, we always pay it. And we've worked out how much it is already. It's £3,000. Now, I've put the calculation in again as a reminder of how we did it, but we did the work on this in our setup, so I'm not going to kind of talk you through it again. We already know that our premium is £3,000. So we have a £21,250 interest payment, less a gain of 1,250, plus we've got then this extra premium payment of £3,000. So our net position overall here is £23,000 as a payment. So that, if you like, is the net interest that we've paid on our 3-month loan after we've gone through all the stages of hedging. Now, I'll not show this calculation on here, but we can work out our true effective annual rate based on that £23,000 payment, just like we did for the effective rate before. Basically, what we end up paying, £23,000, equates to a 4.6% annual interest rate. Now, that's simply because of the premium. We're paying the 4% interest we were capped at by the option, but we're also paying that extra 0.6% premium on top. That's actually worse than the prevailing market rate, which is 4.25%. Now, this does happen sometimes, so options aren't a perfect hedging solution. You could end up paying more here than you would have done if you hadn't hedged. However, they typically act to cap your interest. So we as a company have the security of knowing that that 4.6% is the most you could ever pay. Even if the open market interest rate had risen to 15%, the option would cap us at that worst case 4.6. But as a nice bonus, if the rates had dropped below 4%, so let's say they dropped to 3%, we'd have been able to let the option lapse and just enjoy most of the savings on our loan. So we'd have taken out the loan at the lower 3%, although we would have still had to pay that little 0.6% premium, which is a bit annoying. Ultimately, options are an expensive form of hedging, but they do allow us to significantly cap our exposure to the risk of interest rates moving in the run-up to us taking a loan out. And we may even be able to enjoy any upside benefits if rates have moved in our favour. Now, they are fiddly calculations, but hopefully you've seen how if you just follow the set steps, watch your rates and watch your dates, they are doable and maybe almost close to fun. I might be pushing that too far. I hope you found this video useful. If you have, please like the video and follow the channel. It'll help me put up more videos to help support understanding of the key aspects of finance and strategy. And if you have been, thanks for watching.